Just 1 second before you'll begin the live. Okay. Jaideep sir, so should I give an introduction about you or?
No, not required. I can take it.
Okay, sure, sir. Thank you so much.
Thank you.
Okay, Darshan, okay, we can go live. Okay.
Yeah.
We are live on YouTube now.
Okay, thank you, sir. You can start, sir.
Good evening, ladies and gentlemen. This is the concluding session of World Investor Week, which we have been celebrating since November 23rd onwards. So fortunately, we had the opportunity of listening to various people in this 7 days. 11 people have spoken, and current speaker is the 12th member. So we have variety of speakers coming from various backgrounds, coming from the National Stock Exchange, and as well as people who have worked in regional stock exchanges, and people who worked in NSDL as well as National Stock Exchange, and the faculty who have exposure to, who have been working in the area of capital markets and these financial markets, equity markets. So we have a different combination of the speakers in this 7 days. So this is a wonderful week we had, and many thanks to all of you for joining and encouraging us to go for this investor week. And many people have joined, and their question and answers were very exciting, and speakers were very excited all these 7 days. I got a very good feedback from all of you. Many thanks for all your active participation. And please continue to stay with us through PI, Platform for Investor Protection. All these 7-day videos are already available, with including the current one, it will be available. Yes, lecture videos will be available on PI. So you can watch and you can enjoy the content afterwards also. So today's speaker is Professor Chetan. Professor Chetan is a professor at IIM Bangalore in the area of economics and social sciences. So he has been with IIM Bangalore for the last 12 years, and currently he is a dean faculty. His areas of interest are macroeconomics, monetary economics, and interest rates. And he has been guiding the PhD students and teaching for PGPs and training several corporate executives. And I'm very happy that on Sunday evening, Professor Chetan is ready to give his valuable time at the cost of family time. So Professor Chetan, welcome to this World Investor Week concluding session. I'm very happy that this week is concluding with your session, which is an honor for us in celebrating this week. Thanks to one and all. I request Professor Chetan to start.
Okay. Good evening, and let me begin by thanking the organizers of this event. And in particular, I would like to thank Professor Jaidev for the enormous amount of effort that he has put in bringing this whole event together. And thanks so much, Professor Jaidev, for inviting me. I'm very, very pleased to be here. And so today my talk is going to sort of be about sort of an overview of the macroeconomy currently. So I'm going to start off by just pointing out that India has been amongst the worst hit when you compare across advanced as well as emerging economies when it comes to COVID. And I think any analysis of the current economic situation would only make sense if we sort of get a sense of why is it the case that we were so badly hit by the pandemic. The contraction, as I told you, in the Indian economy was far worse than many of the advanced as well as emerging economies. Some of this, of course, has to do with the fact that we did impose a lockdown, which was pretty stringent. But one has to also bear in mind that we were an economy that went into this pandemic on the back of weak balance sheets. So any analysis of the current situation and any analysis of how we would like to get out and get back to the growth trajectory that we would like to be at would only be meaningful if we have a good understanding of what happened pre-pandemic. So let me start off with that. Let me start off with what I do typically in my MBA class, which is to have this simple equation which tells you, it looks at the GDP of the economy from the demand side. So broadly speaking, the GDP of the economy is the sum of 4 different kinds of expenditures: consumption expenditure, investment expenditure, government expenditure, and the trade balance. And I think it's interesting to look at the fact that over the last 2 decades or so, roughly the Indian economy on average has been growing at about 6.8%. But I think what is really interesting, if you look at the chart below, is that somewhere between, say, 2002 to 2008, our growth seemed to be powered largely by investments, and our growth was also powered by exports. But 2008 seems to have hit us quite badly. The global financial crisis, at least these 2 components of aggregate demand, were hit quite badly post 2008. And therefore, if you look at the period post 2008, in fact, if you look at from say 2012 to 2019 onwards, investment actually turned negative, exports have turned negative growth, and bank credit has also turned negative in terms of growth rate. The point I'm trying to communicate out here is that in the period post 2008, the 2 things that seemed to be driving our economy were consumption, private consumption expenditure, as well as government expenditure. These were the 2 drivers of the economy. Investment and exports had already started slowing down, right? So therefore, I think it stands to reason that if the economy experienced any slowdown in consumption or government expenditure, then the economy would begin to experience a growth slowdown, and as in the case of the pandemic, a contraction, right? And it's also important to understand, I think, that during this period of time, the private consumption expenditure seems to be largely fueled by households leveraging up. So I think this is a story that a lot of us are now quite familiar with. And what we see is that even before the pandemic hit, that is around about 2018 onwards, we find that there is a slowdown happening to aggregate consumption expenditure, private consumption expenditure, both in terms of durables as well as in terms of non-durable consumption, right? So please bear in mind that this was something that was powering the economy so far. And the moment this huge component begins to slow down, and you already have investment in slowdown, you already have exports in slowdown, it is only natural that the economy will begin to experience slow growth. So, and some of these headlines, I think we were also seeing, some of these high frequency indicators that economists now increasingly look at, had sort of indicated that the economy was not in good shape, right? And so people, and the headlines in the newspapers were all screaming about slowdown in 2-wheeler sales, commercial vehicle sales, passenger vehicles, generally the automotive sector. And these are all indicative that consumption expenditure in the economy was beginning to slow down. And the point that I sort of want to make again is this was even before the pandemic hit. And if you look at data from the RBI, then you find that it was around about this period also coincided with decline in capacity utilization. The IIP manufacturing was actually beginning to slow down. And if you look at growth of new orders was slowing down. And then if you look at inventory, both inventory in terms of final goods to sales as well as raw materials to sales, once again, you were seeing that inventory piling up was happening, right? So let me just recap and sort of look at the story so far. So Post 2008, we already saw a slowdown in exports, investments. In fact, both exports and investment growth turned negative around about 2012. The only thing that was powering the economy was consumption expenditure and government expenditure. And then consumption expenditure sort of began to slow down around about 2016, 2017. And as a consequence of which, of course, you have piling up inventory. And when you have piling up inventory, eventually production slows down. And of course, this has ripple effects all over the economy. So when you have an important sector like the auto sector getting hit, there's a domino effect in the rest of the economy. Right. So, of course, there's this very nice piece by Arvind Subramanium and Josh Feldman, who sort of tried to explain what happened to the Indian economy during this period of time. And they have some very nice, interesting facts on what happened to firms. And essentially, the series of which which showed that, corporate profits, for example, started declining, around about 2008. It sort of coincided with the global financial crisis. And what they also point out is this interesting feature that the share of debt owed by companies with an interest coverage ratio of less than 1, and where interest coverage is essentially a measure as a ratio with, where you have some measure of income divided by interest. And so the share of debt of companies owed by companies with an interest coverage ratio of less than 1 started rising. So essentially, I mean, this what this points out is that you have an income slowdown, you have interest payments that are high relative to your income. So firms are struggling at this point of time. And I guess the obvious was to happen, and did happen during this period of time. So you sort of started seeing an increase in the non-performing assets in the financial system. So this is, I sort of want to keep reiterating this point that I'm making, that all of this was happening before the pandemic hit. So in some sense, we go into the pandemic on the back of weak balance sheets. So this was, of course, the first wave of NPAs that sort of hit the economy. And the defaults were largely, as everybody at this point is aware of, it was largely in the infrastructure sector. So you have telecom, infrastructure, textiles, power, steel. This broadly accounted for about 60% of the NPAs in the economy. Then there was this the second wave, so to speak, of defaults, and so there's a very nice chart in their paper which shows that there's this big jump up in bank and NBFC credit from around about September 2017. And the story, I think, that which I think now a lot of people recognize to be true, is that, of course, banks were stuck with a lot of deposits post demonetization, and given the fact that a lot of them had weak capital positions, they were in no mood to lend out to industry. And so a lot of them started making short-term loans to NBFCs and NBFCs were offering a favorable rate. And the NBFCs in turn, increased their exposure to the real estate sector. And this real estate sector, of course, was not in good shape in the sense that, it had piling up inventories. So eventually this sort of maturity mismatch that took place in the balance sheets of NBFCs resulted in your next wave of defaults, in the sense that they were borrowing short term and they were sort of investing in these long-term loans. So this was your second wave of NPAs that hit the economy. And so the obvious implications for the banking sector was that credit growth slowed down considerably. So credit growth to industry, small, medium, and large, considerably declined. Credit growth to large industries declined. And of course, this was reflected in an economic slowdown that we all witnessed. When you look at many of the core sector indicators, like coal, steel, power, electricity generation, all of them had started trending downwards, before the pandemic hit. The point that I sort of wish to make is the following, that so we went into this pandemic on the back of weak balance sheets, particularly weak bank balance sheets. And I think it's important to recognize this feature, as several people, including Viral Acharya and Raghuram Rajan and others, have pointed out, that any sustainable growth will only be accomplished if banks are adequately recapitalized. Because once the recovery begins, then they would be in a process to push credit out into the economy. If they continue to remain weakly capitalized, then any growth may not be sustainable. And this is sort of the point that I wish to make. So I guess the broad, my broad point out here is this is, pre-pandemic, and this perhaps to some extent contributed to the fact that our economy contracted a lot more than some of the other advanced and emerging economies when the pandemic actually hit. So that is one point I wanted to make. So what has happened since? Of course, we had this massive contraction, but recent news seems to be quite favorable. I think we're all reading about it in the papers. So I've just taken this data from the CMIE, and what we are seeing is there seems to be some green shoots of recovery. For example, the IIP seems to be back up. Then non-petroleum exports again seems to be recovering. Rail freight traffic is up. Conventional electricity generation is up. All of this, of course, seems to be pointing towards the fact that economic activity is beginning to kick up again. And this has, I think, largely been driven by the consumption goods sector, because if we look at the IIP index for both consumer durable goods as well as consumer non-durables, I mean, there is a clear recovery that seems to be taking place, particularly post September. So I guess these are things which should make us optimistic. But let's wait for. Let me point out some of the things that we need to be a little bit concerned about. So once again, I mean, I just wanted to point out some of the indices that people are looking at this point. The PMI is up, and what is particularly encouraging is that the PMI for services is up, because the service sector seemed to have been hit quite adversely by the pandemic. So it seems, at least on the basis of this, that some sort of recovery is in place. One of the things that one has to sort of be a little careful about is, we don't have, I think, good data as far as the informal sector is concerned. And this sector, of course, was worst hit by the pandemic. So, so while there is reason to be optimistic, I think it would be prudent to also be cautious in terms of before we sort of, reach some formal conclusion about are we back on the path to sustained growth. So once again, I just wanted to bring your attention to some of these numbers. So the recovery, as I said, has largely been driven by the consumption goods sector, and some of the data points which look very, very positive. For example, passenger vehicle sales. These are in positive territory, and I'm given to understand that the automobile sector is actually increasing its capacity, which is obviously great news. What is also great news is two-wheeler sales are up. This, in some sense, reflects the fact that the rural economy is doing well. There are additional features which make us optimistic about the rural economy. The agricultural sector was the one bright spot during 2020. We have had a record Kharif production, and Rural wage growth again seems to be back in positive territory. This is, I think, good news and augurs well for a consumption-driven economy. So these are, again, as I said, these are all positive, positive features that we have seen in the last month or so, which sort of makes us, I guess, a little bit optimistic going forward. So again, I pulled out this data from the CMIE, and if you look at performance of listed non-financial companies, I think what is very interesting is the fact that net profits is up. In fact, profits seem to be doing very well, and so reason again to be optimistic when you look at these numbers. So I think the other thing that I sort of wanted to point out to was credit, non-food credit. So when you look at industry, overall, it seems to be down, particularly for large industry. Credit growth is still not up, it's still in negative territory. But I guess the positive way to look at this is for medium, micro, and small industry credit growth seems to have recovered. I think this is certainly something that is positive because these are industries which employ a significant percentage of our labor force. So and they were really adversely hit, I think, by the pandemic. I was reading an article which said that the lag between the receipts and payments went up to almost 6 months. They were absolutely credit starved, unable to make labor wages, and as a result of which many of them were closing down. So this is obviously something which is positive. Again, RBI data indicates that personal loans seems to be up, so which I guess augurs well for consumption expenditure. Some people look at this positively. There are others who have been a little worried about this. My colleague here at IIM Bangalore, Professor Vivek Murthy, I think recently had an article in the Mint where he points out to the fact that credit is declining as far as industry is concerned, at least on the aggregate. On the other hand, consumer credit seems to be up, and one of the things that he flagged in his piece in the Mint was the fact that are we looking at another credit bubble? Because the economic activity, credit is not going where economic activity should be taking place, which is the firms. On the other hand, consumer credit is up. So something to certainly pause about. The other way to look at it, of course, is it's good that households are no longer deleveraging, which is what they seem to have been doing during the pandemic, and they're back to sort of borrowing and hopefully spending. So one of the bright spots, I think, of the during this 2020 has sort of been the external accounts. So India, we've traditionally run current account deficits, but because of the collapse in our imports, our current account has moved actually into a surplus at this point of time, which is healthy news. The other thing which again I think is heartening, but though it comes with its own share of risks, is that foreign portfolio investment has been increasing, both in equity as well as in debt. And as a consequence of this, you've got a current account surplus, you've got capital that is coming in. I guess one consequence of this is the fact that foreign exchange reserves have been rising. So we have a healthy foreign exchange reserve position. We have a healthy import cover. So at least on the BOP, we seem to be okay. And I think analysts have pointed this out, that this is, this in some sense has additional implications, because when you think of current account, current account essentially is savings minus investment. So we have a current account surplus. We also have positive capital inflows into the economy. So I guess what this is essentially saying is that net on net, the domestic economy is saving, and you've got also foreign savings entering your economy. I think what that's helpful, and I think this other analysts have also pointed this out, is that most of this savings is making its way into the banking sector. Banks, of course, are still reluctant to lend it out to industry, but the upshot of this is that a lot of them, of course, are buying government bonds. And during this period of time, of course, you have a rising fiscal deficit. You want the government to be spending. And I think that this has given the government some elbow room in terms of financing its spending. So I guess that's one upshot of this, current account surplus and the fact that we are attracting foreign capital inflows. I think the government has not been as stretched as we thought it would be. And the other thing is that the RBI has not really had to monetize the deficit as a lot of people suspected it would have to. So to that extent, I think this is something that has been positive for the economy. So broadly, this sort of was my view of the economy, and I just wanted to also now flag out, some of the concerns that I think people have been raising. One concern obviously is that, what is going to happen to the trade account going forward? This is something that we are obviously concerned about, because a major source of our exports is, of course, European countries. And what we are seeing in Europe is that the infection rate is up again, and economic activity, of course, is slowing down. And I think Europe is about 17% of our exports. So one concern that we have is that, what will happen to exports going forward, given that both in the US and in Europe, the infection rates have been rising. So I think that's something that we ought to be a little wary about. Similarly, on the external front, another red flag, at least as far as I am concerned, is the fact that there's just too much liquidity that is sloshing around. I think central banks all over the world have done a massive expansion of their balance sheets, and we are seeing this massive inflow of capital, and it's flooding our banking system. And the Sensex seems to be moving with the amount of capital that is actually coming in. So of course, people would worry about things like carry trade. You would worry about hot money essentially flowing into the economy. Is it fueling your asset markets? This is obviously a concern, because if at some point of time, as it happened with the taper tantrum, these advanced economies then decide to pull back on their balance sheets, then a lot of this capital might suddenly go. And of course, that has implications for both asset prices as well as exchange rates. So this is something that I think worries us. I think it not only worries us, I think it's a concern for most emerging economies. So yeah, I just thought I would sort of flag this. Right. I think there are other commentators who have also pointed out that the fact that your reserves are rising so much in itself could prompt a risky behavior, because now that importers recognize the fact that the central bank has a lot of reserves, their incentive to hedge is perhaps not as high, and this in turn could prompt risky behavior on the part of importers. So these are some of the things that I think that we need to be sort of concerned about. The main worry, at least as far as I am concerned, at this point is inflation. And this is something that is a bit vexing. One is, of course, the headline inflation is up, and it has been above the RBI target of 6% for some time. It's over 7% at this point of time. That is obviously of concern. And it was, driven, of course, by food inflation. Perhaps the lockdown had something to do with it. So that was something. But economic activity and contact has been back for a long time, but the inflation does not seem to be coming down. What is of even greater concern is the fact that core inflation in the economy has been creeping up. And this is a little worrisome because I think even if you look at all other emerging economies, core inflation has either been stable or it has actually turned negative. And this is what one would expect would happen to core inflation because this is a period that is characterized by weak demand. And therefore, I would expect that core inflation would actually moderate or decline. But in the Indian context, core inflation seems to be rising. I don't. I think I've read different things. I don't have a good sense of why this is happening. One analyst, which I sort of agree with, points out that the fact that CPI inflation has been high and this has sort of affected inflationary expectations, and some of this inflationary expectations is now feeding into the high core inflation. That could be a possibility. What it also might point out is that there are at this point severe structural bottlenecks in the economy, as a consequence of which core inflation is actually rising. So this is something that obviously we want to pay attention to. At the very minimum, it makes the RBI's task much more complicated. So unlike the West, which has slow growth and low inflation, in fact, the only thing that they are concerned about is deflation. India at this point has this twin problem where we have low growth and high inflation. Does this constrain monetary policy? This is something that I think this is something that people are debating, and certainly something that we ought to be concerned about. Let me just point out as far as liquidity is concerned. Clearly, if you look at the repo operations as well as the net, as well as the reverse repo operations, at this point there's surplus liquidity in the system. Banks are essentially putting their money at the reverse repo rate with the RBI. That's where they are parking their funds. So there is actually surplus liquidity in the system at this point of time, thanks to both the operations of the RBI as well as the large amount of foreign capital that we as an economy are receiving. So again, this is a chart that I picked up from the Reserve Bank of India. What we find is the weighted average call rate is closer to the reverse repo, which is what we would expect, in a period of surplus liquidity. So I think that's fine. The short-term interest rate is low, and it's low given the excess liquidity in the system. What really actually is a concern, and I think this is now being debated within the MPC also, is that despite the fact that we've had several interest rate cuts, despite the fact that there is excess liquidity at this point in the banking system, the term premium, which is the difference between the long-term rate and the short-term rate, and in this particular chart, between the 10-year GSEC and the repo, this term premium seems to be rising and increasing. And obviously, this is something that that is of concern. At one level, it is saying that monetary transmission is weak. On the other hand, if the long-term rate continues to be high and is not responding, then the cost of borrowing is high, and investment obviously gets hit. So what explains this, rising term premium in India? I think is a debate, within even the MPC. Well, one argument would be that perhaps this reflects the expectation of rising fiscal deficits. That could be one way to rationalize it. I think the other thing which is actually being hotly debated within the MPC is perhaps this rise in term premium reflects higher expected inflation, given what we are seeing in the economy today. That's one view. And the other view, I believe, and this view I think is more Professor Jayant Verma's view, and I think the other view is the view that has been taken by Dr. Michael Patra, who is the Deputy Governor. And I think in a recent paper that he put out at the RBI, he basically attributes a lot of the term premium to global economic policy uncertainty. And he essentially shows that there's a lot of correlation between the term premium and global economic uncertainty. So essentially what he's saying is that these are actually spillovers that are what, that is what is happening. And these are international spillovers that are sort of affecting the term premium. I think it's important that we sort of wrap our heads around what actually is causing this increase in term premium, because obviously policy would be dependent on it. If it is expected inflation, I think I think the elbow room of the RBI to cut further, it would probably be restricted. And if it's foreign policy spillovers or policy uncertainty spillovers, again, I'm not sure how much something like Operation Twist, which is what the RBI seems to be doing, how helpful that is if these if the term premium is largely coming from international spillovers. So this is something that we need to untangle. I think it's important to understand this in terms of monetary policy. The other things that one is concerned about, and again this I picked up from the CMIE, is the fact that while employment rate seems to be coming back up slowly, income hasn't. So I think they conducted a survey in their consumer pyramids, which essentially asked the percentage of people who think their income will increase compared to a year ago, and that number has actually dropped dramatically. Obviously, this is a problem. If people don't expect their income to rise, then this affects their consumption spending patterns. So this is something that we would obviously be concerned about. So I'm just going to conclude by making a couple of quick points. So I just thought, if we want to be on the path of sustained recovery, and everybody talks about, $5 trillion economy and so on and so forth, I think it's very important that investment in this economy actually pick up. So for example, I think this is from the World Bank. I just picked up this particular chart, and I just wanted to focus on India and China. This is 1990. And the first number that you have out there is the investment rate in India, which is about 26.08. And the size of the bubble basically reflects the sort of size of the economy. And if you look at China, which is on the left-hand side of your chart, the investment rate in 1990 was about 24.56. And I mean, the economy was more or less comparable to the Indian economy, I suppose. But you go back and look at 2018, and you see that you see China on the right-hand side, the big red ball. Investment rate is about 42.29%. So it's a huge investment-driven economy. India, on the other hand, continues, as far as investment is concerned, about 29.3%. And comparably, we are a much smaller economy. I guess the point I'm trying to make is that if we really have aspirations of becoming becoming a large economy, then this investment has to pick up. Private investment has to pick up. And at this point, I think this is the I think this is the big debate, at least as far as I'm concerned. Where is the growth going to come from? So if you go back to that simple equation that I had up there, which is that Y is equal to C plus I plus G plus trade balance. It seems, with incomes not really rising that much, and a lot of people have pointed this out, that this pandemic seems to be more like a permanent shock to income. And if this is sort of a permanent shock to income, then consumption is going to remain subdued for a while, because people are going to try to smooth their consumption. So consumption is not going to really rise. And given the fact that this pandemic has made a lot of these Western economies inward looking, anti-globalization, if you may, it's not clear whether exports are the ones that are going to drive demand. So unless you have these two big drivers of demand, namely you don't, if consumption is not going to grow very fast, if exports are not going to grow very fast, then there's absolutely no incentive for a firm to actually invest or actually build capacity. So the question is, what actually will drive investment, and or what actually would drive demand? I mean, I suppose that's the larger question. So I think a lot of people, and it seems to be the obvious answer, that government expenditure, particularly on infrastructure, has to pick up. And I think there's enough evidence to suggest that this tends to crowd in private investment. So this is something that has to happen. Now, I just again picked up something today from the CMI website, and what I found is that the government, obviously the fiscal deficit has risen, and the government has actually contracted some of its expenditure in April, September. And this is something that the government has been doing consistently. It is actually cutting down on capital expenditure rather than on revenue expenditure. So this is something that I think we need to pay careful attention to, the composition or the mix of the government expenditure. And the share spent on capital expenditure has actually been declining pretty consistently. And that seems quite counterintuitive. I guess the next question that we sort of also want to ask ourselves is, how exactly is the government going to spend? I mean, how is it going to finance this expenditure? Again, this is something which is controversial. There's a huge debate around it. People have talked about perhaps a sale of government assets to facilitate this. But at the very minimum, we need to sort of have this conversation because otherwise it seems to me that it's not clear where this source of recovery is going to be. I don't think it's going to come from sea, and it seems unlikely it's going to come from exports, which means that if you don't have these two, investments may not rise. So something has to power this economy. And it seems to me that infrastructure expenditure, with its large multipliers, would be the appropriate choice. So I'm just going to conclude here. So the objective was to sort of give you, broad overview of what I think about where we are as an economy. I think there are positives. There are certainly green shoots that are taking place at this point of time. But for this to be sustainable, of course, everybody talks about structural reform. There are bottlenecks. The fact that the core inflation is high is a little worrisome. But my own 2 cents would be that we should also focus massively on infrastructure expenditure. So thank you very much. And if there are some questions, obviously, I'm happy to take them.
Thank you, sir. Thank you so much for the wonderful presentation. We have a few questions here, sir.
Yes, please.
So can you please elaborate on the link between pre-pandemic financial deterioration and post-pandemic real output contraction?
Yeah, I mean, the fact is that, you are going into this pandemic already on the back of weak balance sheets, on the back of weak consumption expenditure. And then you get hit by this, by the pandemic, which, and everything that came with it, namely, the lockdowns, the contraction, and all of this simply magnified what was already an existing trend. Firms were already cutting back on their production. Demand was already weak. And then you had the pandemic that throws in more uncertainty, reduces demand even further, reduces economic activity because there's a lockdown. And that simply amplifies this entire effect. And the fact that the firm is entering the pandemic with a balance sheet which is weak, reduces its ability to deal with something. The amount of buffer that it has obviously is much lower. This is in contrast to some of the other advanced economies. For example, the US, I think, went on to this on the back of fairly strong balance sheets. So the amount of buffer that you have to deal with a problem like this is much higher. See, the MSMEs, the small and medium scale enterprises, they were already struggling even before the pandemic began. And then you get hit by this, large negative shock. And, obviously, for some of them, certainly it was the tipping point in terms of having them flows down. So I just want to add to that. So at this point, I think, it's very hard to predict, when exactly a recovery will take place and so on and so forth, because it's so much linked to these health related factors. When is the vaccine going to come? How effective it's going to be? But I think at this point, a policy maker, and this is not something that I'm saying, I think a lot of people have already articulated this, that you've got to make sure that some of these firms stay afloat. The idea is just to make sure they survive this. It's not to make money or profits, but just make sure they survive this, so that when economic activity goes back to being normal, the supply chain is not broken. They are still there. When the demand actually picks up, production can actually take place. People have been talking suddenly, as I said, discovered this love for the English alphabet. We have all kinds of recoveries, V-shaped, L-shaped, K-shaped, and so on and so forth. To me, I think it all reflects the fact, how much structural damage will the pandemic do. By that I mean, is your supply chain going to be permanently broken? Are firms going to be out of the market? In that case, when demand again picks up, will production be able to take place? It won't if some of these firms are out of the market. So at this point, I think we have to focus on sort of staying afloat, and the government should do what it takes, and in my opinion is trying to do that anyway.
Thank you, sir. So there's another question. Some countries utilize financial slowdowns and spend more on infrastructure projects, which seem to be a two-pronged strategy. Could you please, which gives impetus to the economy and complete projects at competitive cost? Could you please enlighten us on this subject, sir?
Yeah, so this is something that I referred to towards the end of the talk. It's very, I think it's important because there's this famous idea in Keynes, I think which is attributed to Keynes, which is called the paradox of thrift, right? And the idea is that when there's periods of uncertainty, when there is a recession, then the private sector will not spend. Period. I mean, even though we know that demand has to pick up, and if demand picks up, we'll be all right. Because of uncertainty, the private sector will not spend, and because they are not going to spend, demand contracts even further. The recession becomes even worse, and you have a number of people losing jobs, and so on. So this is called the paradox of thrift, in the sense that if you save more, you end up saving less because you simply won't have any income, because the firm will not exist any longer. So during these situations in particular, it is very important that some entity in the economy spends, and it's usually the government, right? There's a coordination problem here. I can't get everybody in a room together and tell them that, well, if you all spend in a coordinated way, demand will pick up and we'll be all okay again. So somebody has to spend on everybody's behalf, and it's usually the government. And the second question is, what does the government? It's not just about government spending, right? It has to spend such that it sort of stimulates the rest of the economy, right? And in economics, this is called as the multiplier effect, right? It should spend on sectors which have several interconnections, such that the impact is felt throughout the economy. The multiplier is bigger, and infrastructure is one such thing, right? Infrastructure spending typically tends to have big multipliers, so it's able to lift the economy, and sort of pull it in the direction of a recovery. And what it also does, and there are enough studies, particularly in the Indian context, that point out that it crowds in investment, meaning that when there's infrastructure spending, private investment also rises. If there's a road, which is infrastructure spending, then I am more likely to set up a business, right? So it crowds in private investment. So I mean, so this is a fairly, as I said, it is not something that I came up with, but the worry for me is when you look at the numbers, the capital expenditure is actually not rising. Actually, capital expenditure, both at the state and at the center, for years has actually been declining as a share of the GDP, and that's a concern. That seems to be completely counterintuitive.
Thank you, sir. Sir, considering we are in technical recession as per recent publications, what are your views about timeline for next growth cycle?
I don't have a good answer to that question. A lot of it will depend upon the health aspect of the story. It's obvious, I think, now that there is this obvious trade-off between increased economic activity and infection. And this is what, for example, the West is going through, right? They thought they had it under control. They loosened up a little bit, increased economic activity, increased amount of contact, and now there's increased infection, and now you're back to lockdown in many of these places like UK and France and Germany and so on and so forth. So I think it's very difficult to predict, how we will get out of it. It has to be carefully, I guess, orchestrated. And unless there is a health solution to the problem, I don't think anybody in the world can, say for sure that we'll be out of this problem on this particular date. But as I said, at this point, it's about managing to stay afloat. Even if we are not generating too much of revenues, we want to make sure that there's no hysteresis, as they say. I mean, there's no permanent break in the supply chain. There's no permanent loss of resources. Because then, when the economy begins to get back to normal and the spending actually picks up, they simply will not be the supply chain available for them to produce that particular commodity. So I think that's a part that I think we have to be careful about. We want to make sure that these firms stay afloat.
Thank you, sir. Thanks for the great insights. This is from Mr. Prateek. It is generally observed that the stock markets pre-indicate the economy's performance. Can we really infer the recent bounce in stock markets as an indicator of very fast economic recovery?
I wish I could say yes. You're absolutely right. Stock markets typically take into consideration future economic activity, and that's how assets are priced. If future economic activity is likely to go up, asset prices typically go up. In India, there's a little bit of both, I think, that's happening. One that is happening, as I already mentioned in my talk, is this excess amount of liquidity that we are stuck with. Our banks seem to be flooded with it. There's a lot of capital coming in. Our bank, Reserve Bank of India, also has been easy as far as monetary policy is concerned. And liquidity will always chase something. It's not chasing the product market at this point, so it is chasing the asset market. And in some cases, that's a good thing, because, for example, if asset prices tend to go up, it's not necessarily a bad thing, because your wealth tends to go up, and therefore, demand in the economy actually increases. But eventually, that increase in asset prices must reflect some increased economic activity. If that economic activity is not forthcoming in the next couple of quarters, then obviously I would take that there would be a correction, and the market would correct. So part of it, the asset prices are being driven by liquidity. Part of it is also being driven by our forecasts about what the future is likely to look like. But at the end of the day, this asset price will only be sustainable if economic activity picks up. If economic activity doesn't pick up, then it's more likely to be a bubble.
Thank you, sir. So we'll take the last question of the evening, because there are quite a number of questions coming up, sir. They have a lot of questions to ask. We could take them up later sometime.
Sure, no problem.
Yes, sir. So Mr. Anish Menon asks, if the deposits due to demonetization haven't helped the growth of the economy because of bad NPAs, what is the path that you see that recapitalization could do differently from the deposits?
Deposits are a liability of the bank. Recapitalization is actual capital of the bank, right? And right now, banks don't have capital. And so banks have to actually recapitalize, right? The bank's equity has to increase. So they have to go out and try to raise capital. Most of the banks have been public sector banks. So far, the owner of a public sector bank is largely the government. So the government has been infusing capital. But the fact of the matter is that the government at this point is stretched, and the pandemic has not made the situation any better. So public sector banks have to go out and raise their own capital. Unless they raise their own capital, lending will be a problem. There's no easy way around this problem. And so there are, umpteen solutions that have been proposed. And I don't think we have time to get into all of that. But banks have to recapitalize. Otherwise, the virtuous cycle of credit investment growth will not take place.
Thank you, sir. Sir, should we take another question, sir?
I'm okay if you have time. That's fine.
Yes, sir. Sir, Mr. Yatan wants to ask a question, sir.
Yeah.
Yes, sir. Mr.
Good evening,
Yatan?
sir.
Yeah,
Good
please.
evening, sir.
Yes.
So I just wanted to ask, when we are saying that liquidity is, pushing up the asset prices, and there seems to be a disconnect between what is the actual reality and what the stock prices are reflecting. So why RBI is constantly pumping in the liquidity in the economy?
No, so I'll be very, let me be careful out here. I'm not saying that it is a bubble as yet. I'm saying liquidity definitely is pushing up asset prices. I don't have any empirical evidence to suggest that, but it does seem to be the case based on my conversations. But please remember that some of these increase in asset prices also based on forecasted future, future economic activity. So I think there's a sense that eventually we'll solve this problem, and when we solve this problem, the recovery will be sharp. So an asset price is somewhere along the way also reflecting that feature. As far as why is the RBI pushing in liquidity, I mean, there are some critics of the current policy, but at this point, what the RBI is trying to do is it has to get credit out into the economy. It has to get banks to start lending. Because suppose you're an MSME today, as I said, in some cases, the lag between your receipts and payables is almost 9 months, right? In other words, you have to pay right now, but your receipts are coming after 9 months. So you need working capital. You need banks to lend, and banks need to have credit. So the RBI is pushing in more liquidity, making it easier for banks to lend, right? So the RBI is caught between a rock and a hard place in some sense. Yes, it is watching this increased capital flows, it's watching the high inflation, but it also has to promote economic activity. And the only way it gets to promote economic activity is the thing that it controls, namely liquidity. If I push more liquidity out, hopefully more economic activity will take place.
So then means what will be the option available to RBI to bring back inflation, right? Now is it constantly rising?
Yeah. So I think that's exactly what they are sort of debating. So you've got inflation rising on one end, you've got asset pricing rising on one end, you've got economic activity which is sluggish on the other end.
Yeah.
Right. So there are these three things which seem to be at odds with each other at some level. And I think the approach, so as far as I can see, I think the approach of the RBI so far has been balanced. But my own sense is that if inflation continues to rise, I think their elbow room is very limited.
Yeah. Thank you, sir.
Thank you,
Thanks a
sir.
lot.
Yeah.
Sir, Mr. Vinay wants to ask a question.
Okay. Last question. That's okay.
Sure, sir.
Yeah, hello.
Yes.
Yeah, this is Vinay here, sir.
Yes.
One question, sir. You're basically referring to one of the modes of recovery would be investment by the government on the infrastructure and other policies, right?
Yeah.
But also there was some inputs in the basically in the newspapers and other media that manufacturing would be shifting out of China, or there would be a balanced basically what is a global chain happening, so that everything is not dependent on China. How do you see that also playing a role in the recovery of Indian economy, for example?
Yeah, I think they are interlinked. And one of the things that I pointed out to you is that increased infrastructure investment crowds in private investment. So I think the question that one has to ask oneself, why didn't this investment come into India in the first place, right? And people will point out to the usual things, right? Cost of doing business. And one of the high costs of doing business is lack of infrastructure, lack of roads, lack of ports. These are some of the problems. So in order to facilitate that investment coming into India, you have to first, get all this in place such that, then these firms are able to operate at competitive costs. Otherwise, it won't be competitive to come to this country.
Thanks, sir. Thanks.
Thank you, sir. Thank you so much. And there are so many other questions that people want to ask you. They can definitely get back to you later sometime.
Yeah, please, you can email me. I'm happy to respond.
Thank you so much, sir, for this wonderful and very informative presentation. And thank you to all our online viewers. I hope everybody will be connected to CCMRM, IIM Bangalore, through our PI website. Thank you so much.
Thank you. Let me again take this opportunity to thank the wonderful audience and also thank the center as well as Professor Jaydev for inviting me. Thank you.
Thank you, sir. Thank you so much, sir.